Breaking. US CPI inflation declines to 2.3% in April versus 2.4% forecast. I have some breaking news to share with you right now. The US CPI inflation came in at 2.3% in April versus the 2.4% that was forecast. This is a big beat. This is the lowest print in 3 months, and it is a sign that the Fed may be close to the end of its tightening cycle. The market is pricing in a 25 basis point rate hike in June, but this inflation print could be enough to get the Fed to pause. Remember, the Fed's goal is to get inflation down to 2%. And right now, they're only 30 basis points away from that goal. However, there are 2 important things to keep in mind with this report. First, the headline number was driven by a sharp decline in energy prices. If you take out food and energy, a TION actually increased to 3.6% in April from 3.5% in March. This is slightly above the 3.3% that was forecast, so the core inflation is still a bit sticky. Now, the second thing to keep in mind is that this report only includes data up to the middle of April. We don't know what happened after that, but we do know that oil prices have rebounded in May. In fact, oil is up almost 20% in the last month. So this is likely to push up gas prices, and this will show up in next month's inflation report. So what does this mean for the markets? Well, the stock market is rallying on the news because it's looking past this month's inflation report, and it's pricing in the likelihood of a Fed pause in June. However, I wouldn't be so quick to celebrate. The Fed has already indicated that they are going to pause in June and July to assess the impact of tighter monetary policy on the economy. So this is already being priced into the markets. In my opinion, the stock market is likely to go sideways until we get more clarity on the following. First, we need to see if the Fed will actually pause in June, or if they will continue to hike rates. And second, we need to see what happens in the banking sector. The regional banks have been severely impacted by higher interest rates and tighter lending. And there are concerns that this could lead to a credit crunch. For these reasons, I believe that the next leg up in stocks will be driven by short covering rather than fresh buying. As more traders enter shorts on the expectation that the Fed will continue to hike rates in June, this will force the long-term investors to buy back their positions. This will cause a short squeeze which will push the markets even higher. But this is unlikely to bring in new buyers at these levels. We are currently seeing a lot of short covering in the bond market. In fact, the 10-year Treasury yield just hit 3.7%, which is the highest level in almost 10 months. This is causing some pain in the mortgage market. Mortgage rates just hit a new high of 6.3%. So I think it's safe to say that the pain trade is still intact. As always, keep an eye on the USD as well. Right now, it's trading near its highs against the euro and the pound. A strong dollar is putting downward pressure on earnings, and this is why we're not seeing more upside in stocks. If you want to learn more about the current state of the economy, I've linked a few articles below. Let me know your thoughts in the comments. And if you haven't already, consider subscribing for more weekly content. Thanks for watching, and until next time.